Welcome everyone to today's webinar presented by Reinhart Berner Van Duren and the Wisconsin Veterans Chamber of Commerce. This is part 2 of our COVID-19 legal briefing series, where we discuss some of the legal issues that have been presented by COVID-19 and the impact on small businesses and some proactive steps that small businesses can take during these rather uncertain times. So thank you very much for joining us. And thank you very much for the Wisconsin Veterans Chamber of Commerce. We appreciate being a gold sponsor of the Chamber and supporting all that you do to help Wisconsin's veterans. So thank you. Today, my colleagues will be presenting on various topics. Heidi Gabriel is going to be presenting on payroll tax credits available to employers under the FFCRA and CARES Act. Heidi is a member of our corporate group, as well as having some specialty in tax. My colleague Carla is with our tax group, and she'll be presenting on changes in net operating loss carryback rules and other tax relief available to small businesses. My colleague Josh Taggets is a member of our litigation practice group with a specialty in real estate disputes, and he'll be presenting on the impact of COVID-19 on commercial leasing disputes, evictions, and foreclosures. And my colleague Jeff Roski is going to be presenting on some commercial contracting issues and proactive steps that small businesses can take. Jeff is part of our commercial and competition law group, as well as our litigation group. So thank you very much to my colleagues presenting today, as well as to all of you taking the time out today to participate in this discussion. If you have any questions during this webinar, you can submit those on the sidebar under the questions tab, and we'll address those on an ongoing basis. So we invite you to participate as much as you'd like. So thank you, everyone. The needs to be said that everything being presented today is, not legal advice. This is general information, and the specifics of your individual cases should be discussed with your attorney. We're happy to discuss offline any particular facts and circumstances particular to you. But in general, the advice today is not legal advice. So with that, let's get rolling with the presentation.
Thanks, Tristan. Good afternoon, everyone. I'm Heidi Gabriel, an attorney in Reinhart's Business and Tax Practices. And we're going to start today by discussing 3 payroll tax credits available to certain small and mid-sized businesses created as part of the federal COVID legislation. So I will say the information here is going to be a bit dense. So I do really encourage you to ask any questions using the question box, as Tristan mentioned. The 3 tax credits I'll discuss today, enacted as part of the FFCRA and the CARES Act, are the Emergency Paid Leave Credit, or EPSL, the Expanded Family and Medical Leave Act, or EFMLA, and the Employee Retention Credit, or ERC. These credits are intended to provide a means to continue to pay employees throughout the pandemic and really to help increase cash flow to do so. So I'm going to discuss a little bit about the eligibility requirements, the amount and timing of the credits, and then we'll move on to the mechanics of how to claim the credits and walk through an example. So first, some general information to keep in mind. Each of these credits is exclusive, so there's no double dipping on the same paid wages. And while the credits are exclusive, it is possible that an employer could pay wages and receive all 3 credits for the same employee, because the eligibility requirements could be met for all 3 credits over time. And last, I do want to mention the Social Security tax deferral provisions of the CARES Act. So the CARES Act authorizes all employers to defer the employer portion of Social Security taxes, which are 6.2% of all wages, incurred from March 27 to December 31st of 2020. Now, all employers are eligible for this deferral, regardless of whether you qualify for any payroll tax credits. The one caveat being that once a PPP loan is forgiven, an employer is no longer able to defer the Social Security tax after the date the lender grants forgiveness, but that date likely hasn't happened yet. So everyone should at least be able to be taking advantage of the deferral provisions right now. And then those amounts deferred must be paid back 50% by December 31st of 2021, and then the remaining 50% by December 31 of 2022. So the FFCRA mandates that emergency paid leave be paid by employers with less than 500 employees to employees who are unable to work because of one of the 6 eligibility reasons, those being the employee is subject to a government isolation order, the employee is advised to self-quarantine by a healthcare provider, or is experiencing COVID-19 symptoms and seeking a medical diagnosis, or the employee is caring for someone with COVID, caring for a son or daughter younger than 18 because school or daycare is closed, or they're experiencing any other similar condition. So last week, Shannon from our Labor and Employment Department went into some of the detail and nuances of these eligibility requirements. So I don't want to rehash what she presented, but if you have a question related to any of these requirements, please go ahead and type it in, and I will answer anything that comes up. Similarly, the EFMLA eligibility requirements were covered last week, but as a refresher, the expanded FMLA applies to businesses with less than 500 employees, for employees who have been employed at least 30 days and who are unable to work because an employee is caring for a son or daughter younger than 18 because the school or daycare is closed due to the pandemic. Now, both the EPSL and EFMLA credits are allowed for 100% of the qualifying wages that are mandated by the FFCRA for leave that's taken between April 1st and December 31st of 2020. So the wages mandated for the EPSL credit are to be paid at the employee's regular rate up to the maximum of $511 per day for reasons 1 through 3, that is, the employee is directly affected by COVID-19, up to a $5,110 maximum, and then $200 per day for reasons 4 through 6. The employee is caring for someone else affected by COVID-19, up to the $2,000 maximum. The EFMLA wages are mandated to be paid at 2/3 the employee's regular rate, and the credit is allowed for up to $200 per day for 10 weeks, $10,000 maximum per employee. So in calculating the credits, both credits allow an addition for allocable health expenses and the employer share of Medicare tax associated with these wages. So after you pay the wages, you calculate the additional health expenses that you allocate and add that. Eligibility for the employee retention credit is first made at the business level rather than at the employee level, like the FFCRA credits. So importantly, the credit is not available to those that receive a PPP loan. So it's a one or the other type situation. And the credit is available to businesses and tax exempt entities who are either required to, 1, fully or partially suspend operations due to a government order, or 2, businesses that experience a significant decrease in gross receipts. The IRS did just come out with updated FAQs regarding this credit, so I want to mention a few key points related to both of these eligibility prongs. First, essential businesses that are allowed to remain open under a government order generally would not qualify under this first prong as fully or partially suspending operations. The exceptions to this rule would be if the government order shuts down a supplier to the essential business and the business is unable to get critical supplies to continue its operations, or if the order requires an employer to close its workplace for certain operations, think like restaurant dining rooms, or requires the business to operate at reduced hours, then that essential business may qualify as partially suspended. Even if a business is forced to close as, quote, non-essential, if operations can be continued at the same level through teleworking, a business will not be considered fully or partially suspended. The credit is also limited under this first prong in that the credit is only available for the time period that the order is in place. So for Wisconsin employers who are trying to use this prong to qualify for the ERC, they would be eligible for wages paid from March 25th through May 25th, which is the current stay-at-home order dates. So moving on to prong number 2, any business, whether essential or non-essential, can qualify under the second prong if the gross receipts drop to a percentage less than 50% compared with the same calendar quarter year over year. Once those gross receipts drop less than 50%, the business's eligibility will continue then until the quarter following the quarter when the gross receipts bounce back to 80%, or until the end of 2020, whichever comes first. So this example helps clarify that a bit. If gross receipts drop below 50% in Q1 and then bounce back to over 80 in Q2, the employer would be eligible for the ERC for wages paid in Q1, and the wages would be beginning March 12th, and then all of Q2 wages, but eligibility would then cease at the beginning of Q3. So once you've determined under which prong you might qualify for the ERC, you have to compute your qualifying wages and determine whether you averaged over or under 100 employees in 2019. The 100 employee mark is determined differently than the 500 employee mark for the FFCRA credits. The 100 employees follows the same calculation as the Affordable Care Act in determining Affordable Care Act eligibility. So if you average greater than 100, you're only allowed a credit for wages paid to employees who are not providing services. For instance, if you continue to pay employees for not working at all, those wages would qualify. But also if employees' services have been reduced, say to 60%, and you're still paying employees 100% of their wages, that difference, the 40% paid for no services provided, would then qualify for this credit. And the credit is not 100% of those wages paid, it's 50% of the wages up to a maximum of $5,000 per employee. So now we can kind of discuss the mechanics of claiming the credits. So once you've calculated the amounts, you're allowed to retain the amount without any penalty from your payroll deposits that are submitted either monthly or semi-monthly, depending on your deposit schedule. So if the amount of the credits exceeds those total deposits, you can request a cash refund using Form 7200. And you'll then account for any of those advanced payments or reduced deposits when you file your quarterly 941. Let's go back. Last, you should retain documentation related to the eligibility for the credits, the calculations of qualifying for wages, and calculating your health expenses, and then obviously all of your IRS forms 941 and 7200 that are filed. Also, for example, for eligibility purposes, if an employee is seeking paid leave to care for a child, the IRS requires a statement that includes the name and age of the child, the daycare that's closed, and a representation by that employee that there's no one else to care for the child. And if the child is over 14, the representation has to include that extenuating circumstances exist that require the employee to care for the child. So there are definitely some specific rules as to what kind of documentation you need to retain. So here's an example to illustrate the calculation and how the credits interact with that payroll tax deferral. So if we assume we've got an employer with 75 employees that did not receive a PPP loan, so meaning they're mandated to pay EPSL and EFMLA wages and are eligible for the ERC credit, assuming they satisfy one of those two prongs for eligibility. The employer then, let's assume, has a required deposit of $9,000 for payroll for their first Q2 payroll deposit. So if they paid $3,500 in qualifying EPSL and EFMLA wages since April 1st, including, remember, the allocable health expenses and employer portion of Medicare tax, then they are entitled to 100% of that, which is a $3,500 credit. For the ERC, if they paid $10,000 in qualifying wages since March 12th, including health expenses, they're entitled to 50% of that, or $5,000, for a total credit of $8,500. Note that the ERC wages incurred between March 12th and March 31st is technically first quarter, but the IRS has indicated that those wages and the credit should be reflected on the Q2 2020 return rather than going back and amending your Q1 return. So now let's assume 1,500 of that 9,000 deposit relates to the employer portion of Social Security tax on all the wages. So that 1,500 can be deferred before you do any calculations as to your cash flow from these credits. That 1,500 then is deferred and will be required to be paid back, 750, half of it, on 12/31/2021, and the other half on 12/31/2022. So after deferral, we're down to a $7,500 required deposit, and we apply the $8,500 in credits and come out with a net $1,000 refund. So the employer can then apply for immediate cash of that $1,000 using Form 7200, or wait to file their Form 941 for the quarter to get the cash. So here's what Form 7200 looks like. And it's important to note you're able to anticipate your credits for the quarter and file as many of these requests for refund during the quarter, so long as you don't exceed the amount of credits that you're eligible for, and that you first reduce your payroll deposits to cover the credits. So I've also included here links to the IRS's latest FAQs related to the credits. The rules can be, as I said, very dense. So it's important to make sure that in your particular situation, you're claiming the credits appropriately. So if there's any questions, I'm happy to answer.
Thanks, Heidi. This is Tristan. I don't see any questions coming in. If anyone does have any questions, just as a reminder, you can submit those in the sidebar under the questions tab, and we'll cover those. Also, please know that we are recording this presentation, so we will be releasing both part 1 of this webinar series and the recording from today shortly after today's presentation. So thank you very much, Heidi.
Sure.
Still
with
no
that,
questions? So
yeah.
Go ahead.
I'll pass it on to Carla then.
Thanks, Heidi and Tristan. I'm going to be talking about net operating loss rule changes and then some other tax relief that has come up as a result of COVID-19. So starting off with the net operating losses, I just want to provide a brief background on what net operating losses are. So net operating losses arise when your tax-deductible expenses exceed your tax revenues for a given year. The rules for net operating losses tend to ebb and flow with our economy. So when the economy is really good, we don't allow carrybacks. When the economy is bad, we allow carrybacks as a mechanism to provide some cash to businesses to stimulate the economy. So first, to touch on what the rules were, and when I say pre-CARES Act, I mean the tax reform rules that took place in 2017 under the Tax Cut and Jobs Act. That act eliminated carrybacks and put in place an indefinite carry forward. It also put in place a limitation for NOLs that were generated after 2017. So the limitation was that you could only offset 80% of your taxable income using a net operating loss. The CARES Act made significant changes to these provisions. The first is that any losses that are generated in 2018, 2019, and 2020 can now be carried back 5 years. This is really important and significant for businesses because most will have losses in 2020. It also temporarily suspends the 80% limitation, but a trap for the unwary here is that in tax year 2021, when the limitation comes back into play, there's actually going to be a nuanced test and limitation that comes in. So it's not just strictly the 80% anymore. This is where you'll want to consult with a tax advisor, whether it's us or your accountant, to make sure that you're calculating the limitation correctly. And then lastly, this law is available to both businesses and individuals. Speaking of individuals, there was also another change that pertains to limitations. The Tax Reform Act of 2017 put in place a net business loss limitation on individuals only allowing you to have a loss of $250,000 if you're a single filer or $500,000 if you're married filing jointly. Any excess loss over these thresholds was then converted into a net operating loss, and then the rules that we covered in the last slide became applicable. This was really significant for small businesses and individuals, and so there was some pushback on this, and the CARES Act ended up temporarily suspending these provisions for 2020 and then also retroactively suspending them to January 1 of 2018. So this is good news because it means that if you had a loss in 2018 or 2019, you can now file refund claims to get some cash back in your pocket. So how do you get the refund? Well, the IRS has what it calls a quick refund procedure. And the whole purpose of this procedure is to get your money quickly and to not have to be bogged down in the additional compliance of filing amended returns. So the way that this works is that you file a form. If you're a corporation, it will be Form 1139. If you're an individual, it'll be Form 1045. Then you can also temporarily fax these forms to the IRS for quicker processing. The IRS has been kind of shut down due to COVID-19, but they are processing these and they are doing it relatively quickly. So that temporary procedure has been very helpful because normally you would have to mail the form. Instead, you can fax it. Then just to touch lastly on the last bullet point that I have here, which is the Notice 2020-26. That's a 6-month extension that the IRS put in place for these forms. What I want to highlight is a trap for the unwary. If you utilize this 6-month extension, make sure you check to see if you can still fax the form. Otherwise, you'll need to mail the form. And you want to make sure that you submit the form correctly so that it gets processed and you get your refund. Also, I want to note that you should keep documentation on how you calculated your refund, how you carried back your net operating losses. This is extremely important. In 2008, we did see audits spike for net operating loss carrybacks. So just make sure that you keep that documentation. You'll notice on this slide that I only have corporations and individuals. That's because the procedure is slightly different for partnerships. So if you're a partnership with an NOL, you are able to carry them back, but you have a slightly different procedure to get a refund. Eligible partnerships have to file an amended return. And the way that you do that is you file a Form 1065 like you would normally, but you check the amended return box. You're also going to want to make sure that if you file an amended return, you reissue amended Schedule K-1s to any of your partners. Lastly, the IRS issued guidance saying that when you file this amended return, you need to list at the top, filed pursuant to Rev Proc 2020-23. And the reason for this is to make sure that the amended return is flagged for the IRS as COVID relief, but also hopefully to make sure that it gets processed a little bit quicker so that you get that refund. All right, now I just want to touch on some other forms of relief that's been provided. The first that I thought was relevant is the 401k or thrift saving plans retirement relief. There was a significant amount of changes to retirement plans and some relief that was provided, but I want to cover what was called the coronavirus distribution. And what this is a distribution of up to $100,000 that will not be subject to the early withdrawal tax penalty of 10%. This is significant for a lot of people who are cash strapped and need just a little bit of extra money. We have a more in-depth e-alert pertaining to the retirement changes if you want to see what some of the others were, but I think that that's the most important. The next is charitable contributions. For charitable contributions, there were a number of changes that I'd like to talk about. The first is a new $300 above the line deduction. What this is it allows taxpayers who do not itemize deductions to now get a charitable contribution. So if you don't itemize, you now will be able to get up to $300 if you donate to a qualifying charity. The second is that the AGI limitation for cash contributions for individuals has been removed. So if you were someone who did make a lot of charitable contributions in the past, but you were limited by your income, now you won't have that limitation in place for tax year 2020. The last is that the corporate limitation increased to 25% of taxable income for cash contributions. So another significant change for for corporations who make charitable contributions. Briefly, I want to touch on the payroll protection tax-free forgiveness. So as most of you probably know, the payroll protection program loans that are forgiven are not required to be picked up in your taxable income for federal purposes. Wisconsin passed Act 185, which also says that Wisconsin is not going to make you pick up that forgiveness in your state taxable income. So that's good news. It means that it will be tax-free both federally and for state purposes. The next is mortgage forbearance, and I'm not going to go into depth on this. I just want to bring to your attention that the CARES Act created a right to mortgage forbearance for homeowners who are experiencing hardship for federally backed mortgages. And there was also provision for multifamily mortgages. So make sure that you check on that. Also, just to highlight that some lenders are putting in place hardship programs even if they're not federally backed. So it's something else you can check on if you need to for mortgage forbearance. And then the last that I want to talk about is the Wisconsin property tax relief. Also as part of Act 185, which conformed to some of the federal tax relief provisions, Wisconsin passed some tax relief ability. However, it's not automatic. So what the legislature did is they said municipalities on a case-by-case basis can find hardship and waive interest and penalties on late property tax payments. So important that it's not automatic, and it also requires the municipality to establish this case-by-case criteria to determine if there's hardship. Still worth checking on if you're unable to make your property tax payments and want to see if you can get the interest and penalties waived. The last thing is that it also gave Board of Reviews flexibility in holding their hearings pertaining to property taxes. So if you were planning on challenging your property taxes, the Board of Review may be delayed or it may be held over phone. We've seen a variety of differences throughout the state. So just something to check on with your local municipality if you are planning on challenging your assessment. We also wrote an in-depth alert on this, so you can check our COVID center if you want more details. The last is just a slide with additional resources for the IRS and the NOL rule changes. Make sure to check that out. And again, you can always contact us if you have questions. Tristan, are there any questions?
Thanks, Carla. I don't see any questions at this time. I'll give our participants a moment to submit those. I did have one personal question of a point of clarification. For the NOL, you made the distinction between partnerships and corporations and individuals. That's for tax purposes, correct? So an LLC taxed as a partnership would look at the partnership rules, right?
Correct.
Okay, just want to make that caveat. All right, no questions are submitted, so we'll move on to Josh. Thank you.
All right, thanks, Carla, and thanks, Tristan. My name is Josh Taggett. I am an attorney out of Reinhardt's Madison office. I specialize in real estate litigation. In particular, I handle a lot of commercial leasing disputes. There's kind of four categories of items I wanted to talk about. One is an emergency order that has an impact on the commercial leasing industry. A second is what kind of some things to expect and just planning moving forward if you're in particular, if you're a commercial landlord. And then I wanted to talk about a couple provisions that we expect will be at the center of disputes related to rent payments, and particularly if there are failures to pay rent payments, which one would anticipate in light of the pandemic over the next several months. And then finally, just some recommendations on if you're in the position of the commercial landlord or if you're in the position of being a commercial tenant, some of the strategies that you might think about employing as it relates to rent. So I'll get started here. The first thing I wanted to highlight is emergency order number 15. This does a couple of different things, but primarily it relates to restrictions on foreclosure actions and eviction actions. As it relates to foreclosures, the main thing to know is that foreclosure actions, as well as sheriff sales, are restricted at this time. So none of those are moving forward. The order is in place for about another 3 weeks. It would be set to expire on May 26th. Whether or not it will get extended is, I guess, subject to debate right now. So it's something that could carry into the summer months, or we might see an end to it this month, right around Memorial Day. But in any event, temporarily at least for foreclosures and sheriff sales, those are not moving forward. I think more pertinent to the commercial leasing industry, there's a suspension on evictions right now as well. And so if you are involved in an eviction process or if you are involved in an eviction action, that is temporarily suspended. But also you're not allowed to file an eviction action if you have tenants that are missing rent at this time. The other component that I think is significant here is that the order also prevents landlords from sending notices that terminate tenancies. So a lot of times, if in the common sequence of events, a tenant misses a rent payment at the beginning of a month, the landlord issues a notice of default, and in the notice of default it says if you don't make up the rent payment within the cure period, then we're going to proceed by terminating the tenancy, and if you don't move out, then we're going to move forward to the eviction action. You certainly can still send notices of default out, but what you want to avoid is saying anything about how you're going to terminate the tenancy or how you're going to proceed to an eviction action. We're recommending to landlords at this point that they actually do send notices out if there is a missed rent payment, just to document that that's happened and that that money does remain owed under the lease. But you can't use that typical notice of default form that landlords typically use, because it's likely that the typical form would violate emergency order number 15. So it's something you'd probably want to have some involvement with counsel just to make sure you're covering how you're handling those notices. So I'll move on then. I think one of the things is, well, what do we expect? What have we seen so far in terms of the pandemic's impact on the commercial leasing industry? Well, the first wave that we saw recently here was we've been seeing a lot of tenants, and interestingly, a lot of national chain tenants that have reached out trying to get reductions in rent. And I think to some degree taking advantage of the situation that's out there. A lot of times it's tenants that may actually be able to pay rent, but in light of how the pandemic's impacting their business, they'd like a reduction. And so on the landlord side, I think that's something you've probably already seen or should expect to see over the next couple months. Kind of the longer term, we would expect that this is going to have an impact on businesses, and that you're going to have to be prepared for tenants that are going to miss rent payments, and also for tenants that are going to make arguments about whether it's force majeure or impracticability, about legal reasons that they would actually say they are justified in not paying rent. And I'll speak to a couple of those issues in a minute here. So from a landlord perspective, the most important thing is to have a plan in place. You know, are you going to take a hardline position that the minute rent is missed, it's a default, and barring the lift of the moratorium on evictions, that you're going to proceed with eviction, or are you going to take a more casual approach that, if you can set up a payment plan, if you can do rent deferrals, that might be some separate options to negotiate with tenants that are having a difficult time, and that's going to be subject to the landlord's interest, but also obviously what tenants are capable of doing at this time. One of the caveats we've been mentioning to landlords is, I think if you can take the hardline approach, that's helpful. But keep in mind that if you're evicting tenants over the next couple months, if in light of a failure to pay rent, it could be very difficult to obtain a new tenant in light of the current economic environment. So certainly things that landlords need to keep in mind in that regard. So moving on, I think a couple of the issues that are going to come up in these types of disputes, assuming we do see a large number of missed rent payments, two common ones are force majeure and impracticability. And the idea behind force majeure is typically a lease provision. It's the idea that to the extent that a party is unable to meet one of their lease obligations or contractual obligations as a result of an event that was beyond anyone's control and that was not anticipated at the time the contract was entered into, that they might see some sort of relief from that obligation. As it relates to rent payments, however, there are a couple things that likely preclude a commercial tenant from being able to successfully argue that force majeure allows them to not pay rent. The first one is that it's very commonplace in commercial leases to have an exception, an express exception in force majeure provisions that actually says that the rent obligation is exempt. So the tenant's obligation to pay rent is actually exempt from the foreclosure or from the force majeure provision, in which case it obviously could not be raised as a justification for not paying rent. The second thing is that within the elements that courts typically look at for force majeure, and granted, those can change based on the language that's used in the contract, as force majeure is a contractual provision, so language will matter there. But if it's a typical force majeure provision, courts typically look at a few things. One, they want to see that whatever the event is that's causing the incident was unforeseeable at the time the lease was entered into. Certainly the pandemic would qualify to meet that element. The court also wants to see that some sort of timely notice of the impact of the force majeure event was given. Tenants could certainly comply with that element. But there's another element that typically a tenant would not be able to achieve in order to relieve them from paying rent, and that's that with force majeure, you typically have to show that alternative performance is impossible. And so effectively, if you have an obligation in your lease that says you have to maintain a certain number of hours of operation throughout the week, but if the stay-at-home orders preclude you from actually operating, that would be a very good force majeure case to say, I'm not in default by not maintaining my regular hours of operation. Conversely, however, with rent, there's nothing preventing a tenant from paying rent. I mean, economic circumstances may make paying rent difficult, but it's not made impossible. And so at least the existing case law at this time makes it unlikely that a tenant would be able to argue force majeure relieves them from having to pay rent. Another legal argument that's pretty common at this point in time is impracticability. That's not typically a lease provision, that's more of a legal doctrine. And the typical application of impracticability, or the example that I give, is if I contract with someone to build a casino on my land, and a couple days after we enter into that contract, a local ordinance is passed precluding the construction of new casinos, that would be a prototypical type of case where impracticability could apply. It completely frustrates the purpose of the contract having been entered into. There's no point in proceeding under the contract, and as a result, either side could try to void that contract by virtue of the doctrine of impracticability. So we expect that some tenants may use that type of an argument moving forward as a result of the fact that some of them may have their businesses closed right now, and they could say, well, the purpose of me renting this property is for me to maintain my business, and I can't maintain my business right now. The problem with that argument, and again, why we don't think it's going to get a lot of traction, is that typically with impracticability, you're looking at something that would frustrate the entire purpose of the agreement. So if you have a 5 or 10-year lease that's being temporarily interrupted by a month or two of stay-at-home orders, it's unlikely that a tenant's going to be able to utilize that argument to avoid paying rent. Now, if any of these orders go on for a longer period of time, or if we see these orders coming back into place in the fall or more frequently, those arguments could begin to gain a little bit more traction than what we would see right now. And certainly, if you're on the tenant side, the arguments are probably worth making because at the very least, you may be able to leverage that into some sort of a, whether it's a reduction of rent or maybe some sort of a temporary payment plan or deferral plan that could be helpful. So I guess moving on to legal options and strategies, what would we recommend if you're in the position of a commercial landlord. At this point, I've told people I'm generally staying strong, not making any concessions. You think about it, we're only a month or two into this. Most tenants you would think could survive a month or two in the current environment. Obviously, the more this gets strung out, the more it could become difficult. And businesses could be impacted even once the reopening occurs. And if that happens, that could play out. But again, if I'm the landlord, I'm saying, well, let's see what happens over the next several months. I don't want to make any concessions right now. If absolutely necessary, I'm looking at something like a forbearance agreement with a payment plan, where you're not conceding, rent payments, but you're potentially giving the tenant some sort of temporary relief from having to make those payments immediately. I will note, and I don't have time to get into it on this call, but if there is an advantage to using a forbearance agreement if you're in the position of a landlord as opposed to a deferral agreement. Both would effectively result in, a period of time where the tenant is not having to make the rent payments and they have to make those payments at the end of the deferral period. But you're better off with a forbearance than a deferral for a few different strategic reasons. The other thing is, if I'm the landlord, I'm not giving any credence to force majeure or impracticability or other similar arguments at this point. If any tenants make those arguments, I'm responding strongly in writing to contest those arguments. The other thing is, I'm issuing notices of default. Like I said, I'm recommending landlords go out, they get the notices of default out, they make the statement, we're not allowing rent to not be paid at this time, and trying to collect those rent payments as much as possible, given the uncertainty in the coming months. But obviously also still complying with emergency order number 15. If I'm on the tenant side, if I can't make rent, and if my business really is struggling, and particularly if I've been closed down by the stay-at-home order, I am going to raise those force majeure type arguments, impracticability type arguments. One of the things I would mention is new times and new circumstances, which this certainly is, can lead to the creation of new law. And so there's certainly, those arguments can still be made in good faith at this time. And, it's a matter of, I think, first trying to work those differences out between commercial landlords and tenants and hopefully maintain good relationships throughout this time period, so that litigation doesn't become necessary. So with that, if there's any questions, I'm happy to answer those.
Hi, Josh. We do have a question. If a tenant is evicted or in eviction proceedings, does the tenant still owe rent until the property is released?
Yeah, so typically if a tenant is being evicted, first of all, to the extent that the tenancy has already been terminated in writing by the landlord, which typically happens before the eviction process in court begins, then the tenant is actually a holdover tenant, and they're arguably subject to holdover liability, which is not just rent, but double the rent. And then keep in mind that once a tenant is evicted, that does not relieve them of their obligations to pay rent after the eviction takes place. The landlord would have the obligation to try to mitigate those damages and find a new tenant. But if a new tenant is not found, then the financial obligation of paying rent would continue on beyond even the eviction judgment.
And then, apart from force majeure and impracticability arguments, is there anything that we've been seeing with our tenant-based clients that seem to be successful during these times in getting an extension or a rent change or any other sort of relief on the tenant side?
Yeah, I think that if you're on the tenant side, because the legal arguments are, I think, more pro-landlord as it relates to those issues, I think raising those possibilities in a softer manner, or possibly not raising them at all, is not a bad approach early on. I think if you're really struggling to make rent payments, you want to have that conversation with the landlord as early as possible, and you really want to approach them, I think, initially in less of a formal way and more of a, look, we both have an interest in me as the tenant continuing to make rent payments. If I stop paying rent and have to be evicted, that's going to work out poorly both for you as the landlord and for me as the tenant. So what can we do, or what can we negotiate to make this lease continue to work moving forward, so that we avoid having a situation where the tenant's going to be kicked out. So that would be the approach, and I think that tenants have been successful. We've seen, at the very least, getting into some sort of a deferral or forbearance agreement where they're given a temporarily at least relieved from paying rent, or getting onto some sort of a payment plan that would help bridge the gap during these less certain times.
Great. Thanks, Josh. That's all the questions we have.
All right. Well, thank you both, Josh and Tristan, for that introduction, and good afternoon, everyone. My name is Jeff Ruski, and I'm an attorney in the litigation department in Milwaukee. I'm going to be talking to you today about some proactive steps you can take with your business, specifically with regard to commercial contracts, to prepare for kind of an uncertain future that the coronavirus pandemic has levied on everyone. As you are likely aware, the last few months have been difficult for businesses of all types. And in that time, we've seen several questions come into our office about how contracts may be impacted by the coronavirus pandemic. And so my goal today is to provide you some steps you can apply to your business so that you can be prepared for any contractual issues that may arise in the future. So when I was originally asked to do this presentation, I went back to an old quote that I've always enjoyed, and it's by former UCLA head coach John Wooden. And that quote is, "Failing to prepare is preparing to fail." For those of you who know John Wooden, and even for those that don't, he was considered a great motivator who not only prepared his players for on-the-court success, but also for success off the court. And I think this quote speaks to me so much because it not only applies to sports, but it also applies to really everyday life, including the successful operation of a business. Of course, the underlying message being that you need to prepare for anything that may be thrown your way. And if you do not, you're setting yourself up for future failure. I think the one thing to highlight here is that you need to prepare even if you're not currently impacted by anything that coronavirus has thrown at you, because there's no guarantee that you will be immune from any issues in the future. So by preparing now, you're only going to be helping yourself down the road. So that, of course, raises the question, how can you prepare to make sure that you're ready for any of those issues that may arise? The first step in the process is to check your supply chain and your distribution channels. Now, when I refer to supply chain, I'm talking about the products or services that you may be purchasing. And for distribution channels, I'm speaking about anybody who may be buying your products or your services. And before you get too deep into this step, you really want to step back and take a snapshot of your business and identify what is it that makes your business successful. Is it certain raw materials? Is it components? Is it certain goods or services? You want to note those things. You also want to identify any key suppliers of yours, any customers or distributors who you need for your business to survive. And once you have that information and you are able to put that to paper, you need to determine the potential for interruption. You want to look at if there's going to be any shortages of those goods or services. You also want to try to predict whether there's going to be an inability to fulfill any of the orders that you may make, or also if you're going to have any problems fulfilling any orders that come into you. Getting in front of that is extremely important, and we'll talk a little bit about that a little later on. After you've kind of taken that snapshot and you've come up with a plan and reviewed your supply chain and distribution channels, you want to move on to reviewing your actual contracts and any applicable laws that may apply to those contracts. When I say the word contracts, I'm talking about any supply agreements you may have, distribution agreements, sales agreements, and even terms and conditions. When you're reviewing those contracts, you want to make sure that you're identifying any impacted terms that may have been challenged or may now be at issue because of the coronavirus pandemic. You should review for specific provisions relating to purchase order issuance and acceptance, forecasts and reports, delivery schedules and delivery terms, minimum purchase requirements, whether there's exclusivity of supply, if there's a force majeure clause, which we'll get into a little bit later, allocation of supply, alternate supply sources, indemnification and limitation of liability, and finally, and probably most importantly, whether what the terms are for breach, how you can cure that breach, and what needs to happen in order for there to be a termination. Now, after you've identified these terms, you're also going to pay attention to what terms require you to submit notice, either to your suppliers or to your customers. You need to make sure that when an action occurs that triggers these notice requirements, that you're getting those notifications out the door. And you should really take this as an opportunity to establish or refine your communication plan. Any plan that you have should include what target audience you're trying to get the information out to. It should also include what the format of that message is going to be. Is it going to be a written letter? Is it going to be an email? How exactly are you going to get this out to everyone? And then lastly, timing. When do you want to send it? Do you want to send it before the issue occurs? Do you want to send it as it's occurring? Having all of that in place ahead of time puts everybody in your business on the same page, and it delivers one consistent message to all of the stakeholders in your company. One other thing you want to consider is whether it's advisable to send notice, even if it's not required by your contract. Some things to consider there: will it help you to be transparent with those people that are important to your business? It may create an you're all in this together type of approach that may help things down the road if things do sour. The other question you should be asking is whether you need to respond to any notices that you may receive from your suppliers or your customers. If those notices come in the door and they say they aren't going to be able to accept orders or that they aren't going to be able to fulfill orders, what are your options? And figuring out how to respond to those letters is key. After you've determined whether you need to send out notice, you want to look at any of the risks associated with a breach or a default of your contracts. Specifically here, you want to look at, can performance be excused? And I'm not going to go into all the excuses that may exist. Josh touched on a couple of them in force majeure and impracticability and frustration of purpose earlier. Guy Temple, one of our colleagues, also touched on it during part 1 of this series, and I would recommend you go and look at that for his presentation for some examples on how those defenses may apply. But you certainly wanted to determine whether that's something that's applicable in your contracts, if there's specific provisions that call for when your performance may be excused or when somebody in your chain may have their performance excused. You may also want to seek whether you can ensure performance. And in this, I'm talking about a written assurance of ability to fulfill your order. For instance, if you do receive a notice letter from one of your suppliers or your customers that says they are not going to be able to do something in the near future, do you want to send something to them that says that they will guarantee that they will follow the contract or that they will continue to abide by the terms of the agreement? This is a little bit riskier to do, in my opinion, and the reason being is while it would be great to kind of have that assurance that you can use later on down the road, it can certainly create some tension if you're demanding that the other side fulfill the contract, even in times like this where it's difficult and nobody necessarily knows what's going to happen tomorrow. Lastly, the other thing you want to be checking is whether your customers or you can switch suppliers without incurring liability. To the extent there's something in the contract that says that if there isn't an ability to provide you with the goods that are needed, you are able to go out and find those goods from somebody else, you want to make sure you know about that before you just go and take that step. Because if the contract prevents you, you may be committing a breach without even knowing it. Lastly, you want to evaluate any applicable laws. Now, I say that, but there may not be any laws that apply. But you definitely want to check any state laws, statutes, or regulations for any additional requirements that may exist outside the contract. For example, if your contract doesn't have any type of notice requirement, laws like the Uniform Commercial Code may require when you have to provide notice of either not being able to perform or partial performance. Especially with what's going on with the emergency applicable orders that have kind of been entered throughout the country. To the extent you have a supplier that's not located in Wisconsin or is located, anywhere either in the U.S. or outside the U.S., you may want to look at what those orders state and determine whether those businesses are essential. If they're not able to operate and function, it may affect their ability to get the goods to you. It's better to have a plan ahead of time to what to do when you receive that notice letter. So after you've completed the first two steps, the third step is kind of done in conjunction with those two, really. It's to manage your inventory and your purchases. And as part of this, you want to look at your inventory both in the short term and in the long term. Of course, focusing on any expected shortages that may arise. Regardless of your situation, you should develop a mitigation plan. And now you see on your screen, I have listed two different areas you want to consider: alternate sources allowed and resource allocation formula. For alternate sources allowed, that's really if you're the buyer. And again, it's looking at whether the contract is going to allow for you to go out and search out other suppliers. Before an issue arises, though, you should have an idea in mind of who you may be able to go to get those additional goods if you are in a pinch and you need those things for your business to run. As the seller, you want to come up with a reasonable allocation formula if you cannot fulfill the orders, but partial performance is possible. In this type of situation, the example I always give is, say you normally have 1,000 items that you're going to send out to 4 different customers, and each customer is going to get 250 items. If you can only produce 500 items in that month, you're going to need to come up with a plan to how to send those goods to your customers. And what the law requires here is that you come up with a reasonable allocation formula that is fair to all of your customers. And so the best advice I can give here is to seek some type of information that is defensible and easily identifiable, such as previous year's sales. It can be any other metric that you can point to, and then use that metric to determine how you're going to allocate those 500 goods. The one thing you cannot do is discriminate against one particular customer. So for example, if you have a contract with the 4 individuals, like I said before, and one of those 4 pays more money than the rest, you cannot pay, or at least you cannot send all 250 goods to the one that's paying the most amount of money and then pay the leftovers to the rest of the group. That is not going to fly. But again, if it's based off previous year's sales or if it's based off of some type of defensible model, it's not going to be an issue. Courts have even said that if the formula is reasonable, it does not matter if under another formula a customer would have gotten more goods than what they received. As long as it's fair to everyone and there's a defensible facts behind it, there's not going to be an issue going forward. The last step is to determine applicable insurance policies or other indemnification sources. I'm not going to go into this too much other than to just mention it. Reason being is that Guy Temple discussed this at issue at length in part 1 of this webinar series. So I would suggest you go back and look at the information that he presented to kind of determine some best practices that you may be able to apply to your business. But it's certainly a step that you should take as part of this process with your contracts. So why is all of this important? Why should you go through and take these steps now rather than waiting for something to happen? First off, being proactive can establish clear policies and procedures. Again, when everybody is on the same page, you eliminate potential mistakes or mismessaging. There's no question on the directives on how things are going to be handled when an issue arises. It can also prevent future conflict. You want to make sure that you're addressing potential issues before they arise and before emotions get in the way. One thing that we see all the time in litigation is simple contract solutions probably could have been reached between the parties well before an incident occurred, but instead of reacting to those ahead of time, they wait until it happens and then costly litigation happens. So the goal here is to avoid that from occurring. Of course, litigation is expensive, and so I'm not trying to, knock my own practice. It's important, especially for me, and something I preach all the time is you want to be able to spend a little bit of time and money today. And in doing so, you may be saving yourself significant money and time later on down the road, to the extent you have to defend a suit or bring your own suit for something that could have been taken care of before. Now, some of you may be wondering why I have Victoria's Secret litigation listed here. Because the coronavirus pandemic is so new, in the sense of a legal perspective, there haven't been a lot of cases filed. But this is one you may have seen in the news recently. It involved an over $500 million merger and acquisition where Victoria's Secret was going to be selling itself and part of its brands, or the company that owned Victoria's Secret was going to send part of its brands to a investment firm. And the deal was made during the course of the pandemic earlier this year. And Victoria's Secret's attorneys added a provision into the agreement that essentially excluded pandemic issues from affecting the deal or preventing a close. It was really a great provision to add to the contract because it was something that they did proactively that was going to prevent a future disagreement if pandemic was not mentioned at all in the agreement. Considering that the pandemic was already happening, it was something that was foreseeable and it was known. This goes back to force majeure and excuses of non-performance. But in the end, by adding that provision, Victoria's Secret attorneys have given their clients a very good argument. Now, of course, this is still in litigation. The lawsuit was just filed in Delaware. Actually, both parties filed their own complaints in the action. So we look forward to kind of seeing how that's going to develop here. But certainly it demonstrates, as far as all people who have viewed the case are concerned, that being proactive in this time can really help your clients down the road. The last part about there being an uncertain future, it really kind of speaks to the Victoria's Secret litigation as well. We don't know what's going to come of this. As Josh mentioned, we don't have an idea necessarily of how courts are going to treat this current pandemic. We don't know if they're going to treat this like they did the gas shortage in the 1970s, or that they treated, the courts in New York treated the cases that were filed around the time of September 11th. Or if they're going to completely go out and do something different. And because it may take many months or even years for us to get a clear picture of exactly how courts are going to react to cases involving contract disputes, it's important that we try to avoid that at all costs, and that it involves taking these steps to limit the effect of the pandemic on your business. So as we move away from today, I think the main takeaway is that you want to develop a plan that mitigates risk, limits liability, and allows for flexibility. The last part probably being the most important. None of us know what the future brings. Nobody really understands what tomorrow is going to offer, and nobody understands when issues are going to arise. But if you have a plan that accounts and can move as times change, it's going to only help you succeed in the future. And lastly, as I've said a couple of times now, a proactive approach is certainly better than a reactive approach in all aspects. So with that being said, do you have any questions for me?
I don't see anything coming in right now, so thank you very much. So with
Great,
that,
thank you, everybody.
This will conclude our webinar. Thank you again to all the participants, and thank you again to the Wisconsin Veterans Chamber of Commerce. Both the Part 1 and Part 2 of this webinar series will be going live, so keep an eye out for messages from the Chamber or Reinhardt with links to both parts of this webinar series. If there are other topics that you would like to see covered in possible future presentations such as this, please feel free to reach out to Saul Newton at the Chamber or to myself, and I'd be happy to see what we can do. All right, thank you, everybody, and have a wonderful day.